All right, I think this is clearly one of the highlights of today. I know several of you have been waiting to hear the commentary and insight coming from this particular panel. So gentlemen, thank you so much for being with us. So Rhythm, let me start with you. I don't know where I should start. Elections, earnings, capex, which one to take first. But since we're counting down right now, and given that valuations are already looking so ripe, at this point, at this juncture, really, what's your sense?
So let me just keep the valuation thing out of the way. The market is trading at 3.2 times book, which is right in the middle of its historical range of 2 to 4. There's nothing in valuations either to celebrate or to be worried about. Okay? Now, I know everybody cites the PE ratio and says, oh, the market is trading at 20 times earnings and that's expensive. But remember, earnings are very depressed. We're coming out of an 8-year down cycle in earnings. If you normalize earnings, then the market on a PE multiple is not that rich. So either you normalize earnings and then measure the PE ratio, or default to price to book, which is, which looks through earning cycles. So I don't think we're dealing with difficult valuations. I think the two big drivers for the market, and I would actually go beyond May 23rd. I think May 23rd will be done and dusted very quickly, and people should not, I don't think they should waste too much time on what's going to happen in the elections, except for an entertainment perspective. I think it's earnings and flows. Yeah. So our view is that earnings are turning. India is coming out of a long drawn down cycle in earnings. And our view is that corporate margins will be entering into a 5-year upcycle. So we're going to get very strong earnings, which will drive this market higher. And the second thing is what all these people are doing with their investors, which is investors in India have found new love for equities. We've come out of the period where people did not like equities as an asset class. This is a structural story. It has nothing to do with demonetization. It's a secular shift in investor attitude towards equities, and this will sustain for a long time. It's not going to be over in 1, 2, 3, 5 years. It'll probably go on for another 15, 20 years before it's done and dusted.
Okay, fantastic. So, Bharat, let me bring you in here. In terms of near-term risks, for example, lately we've been talking about crude prices, we've been talking about what if that restricts the possibility of rate softening, as we've all been anticipating, the likely impact of that in the near term, for example, and really the context in the overall global scenario as well. Do you feel there is anything to worry about there?
Well, there'll always be something to worry about. So as you mentioned, there's going to be oil prices, there's going to be a potential El Nino impact, there's going to be volatility if the election results, don't stack up to market expectations. But I guess, we really have to look at the structural drivers of growth. And I think there we are extremely well placed. I mean, we have fantastic demographics, 60% of the population less than 30 years old, and they will continue to grow, they'll continue to consume. You have a major trend in the form of urbanization. 60% of the people living in rural India which can't support them, they'll keep moving to the cities. And then again, look at the infrastructure that we have. I mean, there is so much ability to absorb capital. So I think, these are great structural drivers. And, as Rhythm mentioned, I mean, irrespective of, which government comes or which government does not come, I think these drivers will be there at the fore. And, just to add to it, I think, what we're already seeing is a very meaningful recovery in earnings beginning now. If you see the first 9 months of this year, corporate earnings actually grew at about 13%. This after 4 or 5 years when earnings were growing at 6 to 8%. And the fourth quarter should be very good because of a depressed base effect. So I think we're already in a scenario where earnings will grow for fiscal 19 at about 15% plus. And policy by and large is pro-growth. As you mentioned, we've had 2 rate cuts with the potential of 1 more. Liquidity, I think the central bank is ensuring that it's meaningful out there. And you perhaps will get another rate cut. Yeah. Fiscal policy is reasonably loose too. So I don't think there's too much to worry on the policy side.
Okay. Yep. Okay. Did you want to add something? No. Okay. Mahesh, just to bring you in here as well. I mean, while it's all systems go and everyone's very, confident of the story going forward, investors, or particularly the retail investors, are still questioning the rate of returns. And I know all of you have, at some point or the other talked about, a steady rate of return over a longer period of time. But how do you convince the investor that has perhaps, seen the market in the last round of volatility and perhaps had their fingers burned, that this is just the beginning?
So I think it's important to really look back and what the historical long-term returns have been across asset classes, whether it is equity, debt, real estate. So there's a good long-term data which we have. And what we've seen is that, as I showed in my presentation earlier, equities have given around, on average, around 13%. This is for the index, CAGR, in the last 10 years, 15 years, 20-year time frame. And it's been in line slightly better than the long-term nominal GDP growth rate, a tad higher than that. And that's what I think one should expect. I mean, it might probably be lower in the next decade or so because as our call is that inflation would be lower than what it was historically. So even if real GDP growth is around 7% or so, your nominal GDP will be slightly lower. So you could be a tad lower than that. And funds have given outperformance, like in the last 10 years, the 15-year data, as I showed in the multi-cap category. It's been around 3 to 4% outperformance vis-a-vis the benchmark. I would say that going forward, you should expect that alpha to come down. Anybody's guess where it will be. Looking at the last 1 year, probably people will be worried whether fund managers will be able to generate alpha. But I would like to assure that alpha generation is still very much the Indian markets, and you should expect 2 to 3% at least for 2% for an average fund to deliver that. So that's what I think returns one could expect from the market. And if you are at a time when, okay, if your starting point is good, okay, in terms of valuations, then probably returns could be higher. But I would agree, as Rhythm said, that the starting point is that our market is not exactly very expensive, neither it is cheap. Okay, it's fairly priced. So earnings, market returns will probably track earnings growth in the medium to long term. And that's how I think investors should look at. I think time and again we have seen that 1 year, after a particularly one bad year, normally the next year is always positive. I mean, the probability of that is much higher. That's what we have seen. And last year being a bad year, though Nifty didn't do that bad actually, the broader market was very weak, the mid-cap and small-cap index. I think that should probably come back in this calendar year. And I think long-term returns will again gravitate back to the returns of what the asset class has given in the last 5-10 years, I would say.
Rhythm, let me bring you back in here. What do you think? In terms of the return scenario, you talked about flows earlier as well. We've been, the beneficiaries of very strong flows. Do you see that continuing as well?
So I think the danger here is that we are all in agreement with each other. So, so unfortunately or fortunately, I have to agree with Mahesh in the sense that if you look at the 30-year CAGR on the Sensex, it's approximately 16%. I think the next 10 or 15 years will be a tad lower. The reason is because I think if India's inflation framework doesn't change, and I think it's going to be hard for any new administration to change it, I think we're looking at lower inflation for India. So real returns will be in line, but we're coming out of a 30-year period where inflation was averaging, say, 6 or 7%. That number goes down to 4. You lose a couple of points on nominal returns. And therefore, investors have to anchor themselves to slightly lower returns. Now, let me just tell you what is the risk of expecting high returns, right? Then what can actually happen? The risk is you'll miss the market. See, when you're expecting high returns, you need the valuations to be a whole lot lower, okay, right? So you miss actually buying equities because your expected returns are too high. Therefore, it's very important for investors to lower their expectations a tad, not a whole lot, but by a couple of points, so that they don't miss the equity bull market. So that I think is the critical takeaway for me. But I'm in agreement with Mahesh that the returns in the next 5-10 years will be lower. Now, there could be, equities don't behave in a linear fashion. They're not like fixed deposits. You don't wake up every morning and a little gets added to your bank account. They come in fits and starts. They get bunched up. My view is that we may get a lot of the next 10 years returns in the next 3 or 4 years. So it's going to be quite bunched up. And then after that, I think we'll get a bigger bear market, and then returns will actually turn negative. But I think in the next 3-4 years, we should get more than the average returns that we have got in the last couple of decades.
All right, that's an essential point as well to take away for investors. Manish, I want to bring you in here as well and talk about, in terms of what we were just discussing with regards to rates, inflation, the outlook going forward. Again, if one interprets that into the return scenario, how are we looking at things? Do you perhaps see a softening going forward? Do you see that boosting sentiment or driving consumption, driving growth, and having its own part?
I think the other panelists and in my presentation also we kind of discussed that inflation broadly is underwhelming. Pretty much everyone in India kind of believe that we tend to inflate at about 7-8%. It's been more like 4.5% for the last 3-4 years. For a variety of reasons, I think we've discussed at length since morning about them, so I'm not going to repeat them. It has large implications on all sorts of assets, and what Rhythm mentioned, that one must, at least from a nominal standpoint, should look at lower returns because inflation is going to trend about 3 to 4% lower than what historically it's been. The good news, of course, is that the real rates, given that the policymakers are anchoring you and the policy rates and fixed deposits and AAAs and everyone to at much higher real rate. A financial saver, would most probably earn a reasonable premium. He was always cheated, actually, by our system for the last many, many decades. It's a bit of a financial repression, which went on in the country because banks, like it happens in China, offer very, very low levels of returns and low real returns. I think that's kind of has changed over the last 3-4 years, so which is actually a good news. I'm not sure, here I just want to come in that, one of the reasons why the nominal returns in equity would be depressed, apart from the reasons that Rhythm and Mahesh talked of, is that, India has typically been a very, very capital-starved and a capacity-starved economy. That's typically a case when, a country moves from $1,000 to $2,000, it's kind of discovered by many investors, promoters, entrepreneurs, and so on and so forth. For the size of ours, we by now have built a reasonable amount of capital stock ready to be deployed. This, we wouldn't have imagined, so many people coming in from all sorts of places in this country to deploy capital. So, which essentially is about, tells you that it's an evolution in the mindset of an investor that he's ready to kind of deploy risk capital. Which essentially, this also means that your returns would be somewhat depressed because there's a lot more capital today to be deployed, both by promoters and investors, which essentially means that your assets are relatively more expensive. Something similar happened to properties 4-5 years ago, and we've seen a bit of a stagnation. I think it's fair to assume that given that we are no more capital starved, and no more capacity starved, and our infra and much of the capital stock has kind of improved substantially. We love to talk about 30 years return, but 80s and early 90s were very different. We barely saw what do you call manufacturing and the capacities of the sorts that we see today in the country. So my sense is that this is also a reason why India's stock would not earn the returns that it's kind of historically earned. Kind of taking a bit of a detour, but yeah.
Okay. Do either of you want to answer to that? Can we have a disagreement here, or are we all in agreement?
I just
again?
wanted to kind of induce a bit of a disagreement.
Yeah, I wanted to just disrupt things a little
smart
bit.
panelists was on one side.
I can happily disagree, but it gets too technical, which is India still suffers a saving deficit. In the foreseeable future, we are not going away. And the way to measure the saving deficit is to see the current account. And the current account represents the gap between the saving and the investment rate, and that's negative, which means that we still have to import saving from the rest of the world. Now, the good news is that the world is very happy to put its saving in India, and it's doing it at a rate which is greater than what we need. So, while I disagree on part of the point, the other point is that, and this is the difference between the capital stock and the flow. Sure. The flow looks very strong. And to that extent, asset valuations are no longer at depressed levels. So this is not 2001, 2002. Sure. It is not 2009. This is a little different. So it's not like we're looking at hyper returns in equities or, in fact, any other asset class. So part disagreement, but overall.
A small point here that, the United States at $60,000 of per capita continues to be a current account deficit. So to say that we are current account deficit economy and therefore we don't have enough saving is untrue. Maybe it is the way to explain this is that the world does see an opportunity of us to grow faster than humanity grows, which is 3.5%, and which is why a lot more capital is frankly ready to get deployed. So which essentially goes back to the same point that a lot more capital, not only local domestic capital, but also the global capital ready to get deployed here. Yeah.
We should take it.
We can go on.
All right, let me bring you back in, Bharat, and somehow apply this, theme of flows and capital coming to India, into really where you see the markets going, the kind of returns that you see as well.
Well, I think, we should be reasonably positive in terms of flows coming into this country. Because, here is a world where, which is flush with liquidity. Central banks are going out of their way to ensure that liquidity is very, very abundant and plentiful. And, when they start looking at areas of growth where they can make reasonable returns, they can find very few economies like India growing at this kind of growth rate, and more importantly, with this kind of potential. Because you look at China, I think demographics in China have peaked out 3 or 4 years back. In fact, I think the US now has better demographics than China does because they have immigration. So the kind of growth potential that we offer, I think, is something which is very meaningful and which should remain attractive for a long time. And I don't think we've even scratched the surface in terms of money coming into this country. Just let's look at the data. If you just look at it in the context of emerging markets, investors are running a neutral position on India at this point in time. That's it. I mean, they're not meaningfully overweight, and they're meaningfully overweight on a couple of stocks, which means they're actually underweight the rest of the universe as far as India is concerned. And India has a weight of just about 9% in the EM index. Again, if you look at India in the context of the global index, I mean, we have a weight of less than 1%. And this weight is only going to grow by leaps and bounds. And again, investors are barely running a neutral position. And this is a market where perhaps they should be running an overweight position given the growth potential. So I think, in terms of the flows, there'll obviously be, volatility depending on what central banks globally do. And we'll have to live with that volatility. But if you're taking a 3-5-year view, we should feel very optimistic about money coming into the country.
Okay, and Mahesh, I'm going to come back to you in a moment, but it's interesting because lately and on air, the number of experts that we've been speaking to, they've all been coining this as the start of the new 10-year rally. And both of you have been talking today about the 3 to 5 year perspective, and you've actually said, no, we might actually see a shift in trend after 5 years. Why is that, Rhythm?
It's too far out,
Yeah,
actually.
but still, why?
Because I think equities don't behave in a linear fashion. This bull market is not a new one. It's aging, actually. It started in 2009. We've not had any major correction since then. No correction has actually exceeded 20%. Okay, so therefore the bull market, in my view, started in March 2009. We're now in it's completed 10 years. It's the longest bull market in India's history, though albeit the slowest one in terms of returns. And I think, usually the bull markets give you the maximum returns at the end. And the next 3 or 4 years will represent that period where you want to be in the market. If you miss this 3 or 4 years, then you would have missed most of it. It was okay not to be in until now, but now you want to be there. And then the markets, I think, get overvalued because you get a big earnings cycle. The market gets very optimistic. PE multiples expand. The price to book goes over 4. And from those levels, then, equities become a little dangerous.
Okay, fair point. I'm going to come back and talk about where to invest in a moment. I know that's what everyone's also waiting to hear. But Mahesh, in terms of domestic participation, we've talked a lot about flows, how they're going to continue to come. There's no risk. Slight ebbing in domestic participation of late. Do you see that coming back? Do you see that coming back with a bang? Because right now, there is no real alternative asset class that's offering such returns at this point, or that's looking so attractive.
Yeah, so if you look at in terms of the domestic flows, clearly they have slowed down compared to, I think what we saw after demonetization was a huge increase. I think that was not likely to sustain. I think what we are currently seeing in the market in terms of SIP flow, which is roughly around 8,000 crores on a monthly basis, I think that looks to be much more stable monthly inflow. And then some lump sum investments, I think we've seen that money getting held back because of some uncertainty about elections. I think once that event is behind us, you could see that money also coming in. So I think the way penetration, we are seeing a lot of new investors coming into the investor base in the last 2 years. So that has expanded the overall base. And people have also started to be much more mature in terms of holding on, not exiting, throwing in a towel like last year when we've seen huge volatility, especially on the mid and small caps. And we haven't seen any large redemptions over there. So I think that helping in terms of building up the equity culture. And also while we have seen a big acceleration compared to what it was around 4 years back, still inflows into equities is still around 4.5% of your overall savings. I mean, that number can still increase if you take a longer term period. And money coming in through the pension fund, the PPF, and the other schemes, I think that ratio will be a very steady flow coming in, and it will only increase as your savings goes up. So given these factors, I would say that you should see inflows post-elections. Probably you could see some uptake then from what we are seeing current levels, and then it will grow at a normal pace. Obviously, there will be periods where you could see some volatility depending on the market movements. But I think secularly, I think we would agree with what Rhythm has said, that we should see the overall inflow into equities rise over the next decade or so.
Okay, so where is the money going? That's the big question. I know, Rhythm, you've talked a lot about cyclicals and perhaps the move there. Is that something that you're still closely looking at? You know, talk us through the thought behind it, why you think that's going to be the next big theme.
I think it all depends on time frame. Sure. So if your time frame is longer term, then I think the two best sectors will be financials and consumers. Because India's consumption, you know, I think there's an interesting point that Manish mentioned about the transition in per capita income. So we've gone from 1,000 to 2,000. Now we are going from 2,000 to 4,000. And when we go from 2,000 to 4,000, there'll be a perceptible shift in how this country consumes. You know, $2,000 makes us a very poor country. We are a poor country. The people here in this room are an exception. This is not the typical Indian. The typical Indian is surviving with great difficulty and is largely spending his income or her income on buying food. But when that average income goes beyond $2,000, suddenly you get spare income to consume other things. So I don't think the market is oblivious to this, which is why I think there's a bid on consumer stocks, because the market realizes that a lot of segments in consumption will grow a whole lot faster than the economy. So I think that will be an exciting space. Whenever these stocks correct, I think they represent great opportunities to invest. Some of them are currently also trading at attractive valuations, like the automobile stocks, which have gone through a rough patch, and I think they've sold off and now they're looking attractive. Others may not be, but consumption is a big theme. And along with that is financials, because this country will lever up. Okay, I think the urge to spend the future income is only going to rise. And therefore, the growing younger generation in India will lever up. And when they lever up, they'll generate credit growth for the banks, and the banks will make a lot of money. So the banks and the consumption stocks are the place to be. Thematically, I would avoid the exporters because I think they'll underperform. But you know, the market has its own cycles and things go up and down. So at various points in time, they become more attractively valued. I think we had one such phase in software stocks 2 years ago. That phase is over now. And with regards to cyclicals, that's largely to do with where we are in the economy. If the economy is going to pick up, then I think industrials will do well. But you know, industrials tend to be cyclical, so I don't think there's a secular theme there.
Okay. Manish, let me bring you in as well, since you know we're talking about some of the themes that you know you look at closely as well. And you know, where do you see action picking up in the markets? Would it be in some of the beaten down sectors? Where do you see new leadership? Are you sticking to, as Rhythm mentioned, themes driven by the consumption story, for example, by the spending story?
No, so I agree with Rhythm that, you know, we are grossly underbuilt and underhoused economy, and I will leave Mahesh and everyone else to kind of talk about valuation, but what this country requires, of course, is that we must build houses. We need to focus on hyper-local businesses, you know, instead of goods. And so, you know, at this stage of economy, you know, instead of focusing on tertiary economy, if we could ensure that per capita housing kind of improves, it improves the all sorts of local area businesses, be it furniture, paint, and everything else. You know, it would employ millions and millions of people that we need to kind of employ. So my sense is that, you know, I think there was a bit of a misplaced idea in this government and not kind of favoring the physical economy, the real estate economy, so to say, and I think it's beginning to correct. My sense is that over the next few years, we're going to do what China has done in front of us and, you know, basically build big cities, and they shall come and, you know, inhabit them, and eventually we'll have a big boom in productivity. So I think, you know, build construction. I think in somewhere in one of the presentations, someone mentioned about agriculture. You know, it's often, you know, ignored. I think we can be granary to the world and basically convert the food articles that we produce, you know, from a primary good to secondary, and you know, begin to kind of offer to the world. and the sectors like tourism and so forth. So instead of kind of replicating China for what it's done to the goods, I think what Guru Murthy kind of mentioned in the morning, we're going to build our own economy. And looking at a place in this world which is so full of goods, that China and many other East European countries and now Asian countries are supplying. Look for gaps in the world and basically create an economy in and around those themes.
Okay. All right. Bharat, what are the themes you are looking at? And let me also give you a chance to respond to the earlier point on the savings and current account deficit.
No, I'll just take off from where I think Manish left. I think, see, obviously consumption is a great theme in India. I mean, given the demographics and given the urbanization. But I think the challenge that, fund managers like Mahesh will typically run into is the fact that, the conventional consumption stocks that are listed on the exchanges right now, there's a valuation headwind out there because, they're fairly expensive. I'm not saying they're sales, but, they'll compound with earnings growth, but, you're not going to make super normal money out there. But within consumption, I think there's going to be a great opportunity in terms of the new age services that open up and that will come to market. I mean, you look at things like education, hospitality, hotels, or for that matter, even things like insurance or aviation. I think, the consumer is now getting into most of these services. And these are very, very underpenetrated markets. So I think, one, there's going to be a huge opportunity out there over the next 2-3 years because we'll see a lot of private equity money has already gone into these areas. And they will now come to the public markets. So I think there'll be a very meaningful opportunity in, in internet, in retail, in insurance, aviation, all the themes that I mentioned. And I think this is one place where a lot of money can be made. And you don't have any headwinds in terms of valuations. Apart from that, I think also over the next 2 years, it's difficult to time, but I think we will see a recovery in the investment cycle. It's been long coming. We haven't had reasonable investments in this economy because of the binge we saw between 2003-4 all the way till 2010-11. And because of that, utilization levels have been lower. But the interesting bit is now that utilization levels are now getting near the 80% handle. And that typically always sparks off a very meaningful upside in terms of investments. So I think these are new areas where perhaps valuations are not going to be headwinds and where there's going to be reasonable money made.
Okay, so let's get your take on valuations then, Mahesh, particularly in some of the newer themes that everyone's looking at.
Yeah, so the valuation, as I mentioned earlier also in my presentation, it's a lot of divergent dispersion which is there. Like there are a few sectors which are doing well, but they are very expensive. There are the other sectors, okay, where they like, for example, utilities, metals, capital goods for that matter, where the valuations are below the long-term average. I think potentially there could be some mean reversion over there if we see improvement in these sectors. So some of the, not so fancied sector like the utilities, for example, where I think the risk reward looks fairly good over there because in the power sector, while we've seen a lot of pain over there, I think the way capacities are likely to come up and the demand the way it is growing, I think you will see new capacity creation needs to happen in the next 2 to 3 years down the line. And some of the problems in the sector will also get resolved. So I think utilities, again, not a fancied sector, but quoting at around 1.2 times book value with reasonable ROEs, I think sectors which one can look at as a contra play over there. And apart from that, a lot of these niche sectors which are there, which normally don't get highlighted in the main sectors. For example, chemicals, okay, because what's happening is that in China, because of the increase in tighter pollution control norms and because of increase in labor costs, and it's an opportunity which a lot of the Indian companies are seeing that because of shutdown in capacities over there. So especially companies which are there into specialty chemicals, not so much in the commodity side, I think we have seen a good improvement in the margins and also companies going ahead and doing capex and increasing capacity and capturing a larger share of the global pie. So these are some of the pockets besides all the other big sectors which normally one tends to focus in where probably we could make better alpha in the next couple of years.
Okay, I just want to touch upon aviation because you said that given all the news of late and we've spoken both to the Jet and SpiceJet CEOs exclusively on ET now in the last 2 days, but you still said aviation, despite the fact that we've seen 2 airlines, 3 in fact, 2 listed airlines go down. Yes, I know that Spice, Indigo are seeing some traction, but you still believe in the story?
I do believe in the story because, India is a large and heterogeneous country and, people do travel a lot. I mean, and as I said, migration is a big part of the theme because, 60% of the people, have their homes in the rural India and, they travel to cities for earning their livelihood. And so there's a lot of travel that is going on. The Indian Railways clearly can't bear the entire burden, and which is reflected in the level of services that we see. And also it's time consuming. As I said, it's a large country. So I guess, we're just scratching the surface in terms of, the potential for the aviation sector. For a country this large, we have just about 100 airports, and even there, a lot of them have come up in the recent past. So I think, there's a lot of potential out there.
Okay, so it's not a dead story yet. Rhythm, whether from among these or even as you were earlier saying, since financials continues to be a priority, within that, how would you break it up? Where do you see the most potential?
Yeah, okay, so I think banks obviously look interesting. The private sector banks, I think, are very well placed because the public sector banks are short of capital, and that's not a problem that will be resolved anytime soon. I think there are enough political headwinds to privatize them. So the private sector gains share in a market where you have headline growth of, say, between 12 to 15%, and your biggest competitor is losing share. So a lot of private sector banks will see high double-digit top-line growth. So that's a very healthy growth environment. I think select non-banking finance companies will do well. And some of them have really become quite cheap in the recent carnage that we saw because of the liquidity crunch. Now, clearly, some business models need to evolve because they were running very tight on liquidity with low capital levels, and therefore that consolidation will slow down growth. But there are others that are actually run pretty fine, and especially the ones with strong promoter backing, where capital is not a problem. I think will actually do quite well and gain market share. And then I think we should not forget real estate, because real estate is part of the financial sector, and I think real estate is going to boom. We're coming out of a big down cycle in real estate. I think inventory levels have peaked, and we should see a fairly good pickup in demand because affordability is the best it has been in India's history. Prices have not gone anywhere in many markets, and incomes have gone up everywhere. So I think real estate is set for a pretty strong run in the next couple of years.
We have this amazing ability when it comes to our markets to shake off bad news, to get back into certain stories and certain stocks. But, something like a real estate has been incredibly beaten down. But you're all sounding very positive on the story going ahead. But are investors buying in?
If you're not an optimist, don't come to the equity markets. Okay, go to bonds, go to fixed deposits, go to places where pessimism works. Sorry, I didn't mean to say you're a pessimist, but if you have to be an optimist if you're in equity markets, I'll tell you why.
These days, if you're not ready to take a lot of risk, at least don't come to fixed income.
Yeah. I'll tell you why you have
you
to
could
be
go
an
to equity.
You have to be an optimist because equity markets is about imagination. And only optimists can imagine. If you're going to imagine that the world is going to end, then you better look for some place on Mars. But otherwise, there's no way otherwise to be in the equity market. So yeah, we have to shirk off bad news. Of course, bad news can be very bad, and then you have to stay off, protect your capital. That's the first rule of investing, protect capital. But if the bad news is not that bad, then it's an opportunity, like October to December proved to be. Right?
Okay, absolutely. One of the themes would you like to respond? One of the themes none of you spoke about is telecom, and I bring that up because we all know the story in telecom. We all know the cost pressures, the margin pressures, it's capital intensive, so on and so forth. But we also know the other side, and we know what's happening with Reliance and Jio and so on. So just want to get your take. What do you think of telecom? Would you, via any of the companies, want to be in the space?
It depends on your time frame, really. I think there are a lot of positives building up in that space. We've seen very meaningful consolidation. We don't have the number of players that we used to have. We used to have 6 or 7 players per circle. Now I think we're down to about 3 large players in every circle. And I think companies by and large are backed by very strong promoter groups. So I don't think capital is an issue. I guess yes, what you're seeing is an increase in competitive intensity. But I think if you're willing to live it out, it could carry on for another 6 months to a year. But once the market share aspirations of most of the lead players have been met and we see some kind of crystallization there, I think the leverage in that space can be meaningful. So I think there's money to be made there, but you just need to have a time frame commensurate with what's happening with competitive intensity there.
All right, I have a few questions for all of you from the audience. Let me start off with Rhythm. Rhythm, the question is, from the last 24 months, crude has been almost double, but inflation has still been under control. Why is that?
See, that's one of the biggest successes of the outgoing administration. In 2015, they accepted the recommendations of the RBI and moved to a real rate framework. And simultaneously, they exercised great restraint in raising food prices. So what has happened as a consequence is that the second round effect of oil and food has been very muted. And we've been able to absorb these shocks in oil prices from time to time. So this is a great success of our inflation management story, and I think it will continue over the future years if we do not move away from this inflation framework, which I don't think we will, but that is the big if. I think we should see this continuing.
Okay. For Bharat now, what is your take on the gig economy? What role can the financial sector play in order to support and encourage it? The gig economy, which even I'm a little uncertain. Who asked the question? Gig economy. Gig. Yeah. Do you mean? Yeah, I think perhaps, do you mean e-commerce?
Uber.
Yeah, okay.
Oh, okay.
Yeah. I know, Bharat's like, are they really asking me?
So if you could just repeat the
Yeah,
question, please.
so actually on tech, e-commerce, we don't have we have a fair amount, but we may not have as many listed representatives. So what's your take on that economy and whether or not perhaps you feel we'd get a bigger chance to engage in it going ahead?
No, absolutely. I think, what we've seen as far as this economy is that, market penetration levels are what they are. We all use these services almost on a daily basis. So I think, penetration levels are very high and they're here to stay. I guess just what's happened is, we've had a peculiar quirk in the case of India that, private markets have offered, a more attractive cost of capital. The capital cost there has been lower than it's been in the public markets for a variety of reasons. And so companies have preferred to access the private markets to start with. But that said, the private equity investors will need an exit at some point in time. And we've been averaging almost $10 billion in private equity investments every year for the last 10 or 12 years. So all this paper is going to at some point in time potentially hit the public markets. And so I think we'll definitely have an opportunity to participate in the growth of these companies. And I think there'll be very attractive growth opportunities.
For Manish now, the RBI has introduced currency swaps for liquidity in the debt market earlier, deviating from the commonly used OMOs. Why do you think this was undertaken, and did it address the liquidity crunch?
So it was increasingly a bit of a worry that RBI was crowding out the bond markets by, pretty much buying everything that the government on a net basis was supply last year. The OMO last year was about 3 lakh crores, so it was a very substantial part of the overall government borrowing. So there's always a fear of, we actually not letting the rates express themselves, truly and fairly if RBI continues to buy a large part of government borrowing, which is probably why forex swap was introduced. I think, along with this, there was also a realization amongst policymakers that OMO as a tool does not talk to the risk markets. Basically, when OMO is conducted, technical it is, but what it happens, of course, is that invariably public sector banks actually give up the security and get the security, and they don't make good use of it. Whereas forex swap market actually talks to the risk market directly. It actually talks to the 2-year, 3-year corporate bonds. It depresses the term premia for the private sector bonds, and then invariably that leads to a bit of a risk on, which is what we've been trying to engineer in last 5-6 months. Especially when RBI kind of changed its view in 4-5 months ago. So my sense is that it's both things. One is, of course, the fear of almost crowding out the government bond, but also I think a realization that the swap window would actually improve the efficacy of monetary policy and liquidity as such.
Finally, for Mahesh. Mahesh, consumption is expected to be a major contributor towards the 5 trillion economy. How important will generating jobs and rural market disposable income, which are presently in distress, How important is that in achieving this milestone?
Yeah, so I think consumption, I think, can't go on its own. It needs the support of increasing income levels, either in job creation. So while there's a lot of talk about whether job creation is actually happening in the economy, so we had Guru Murthy talking in the morning also that in the informal economy, I think that's where I think we need to create employment opportunities. And a lot of jobs in the organized sector, probably that creation won't be as large because increasingly as manufacturing is becoming more automated, you need to create that environment where small businesses can come up, small entrepreneurs can come up and thrive. And that's where I think the government focus has been in terms of provide liquidity, provide credit to that sector. And that's where India has been an entrepreneurial country. We've seen that culture. And if there's a right policy framework and credit is made available to that segment at a competitive price, I think we should see that really drive the overall income levels in the country, and that in turn will drive consumption, I would say.
Okay. Rhythm, we have one more question for you. Increase in weight for China in the MSCI and likely flow impact in India, your views?
I don't see much flow impact. I think eventually India's weight will also go up. So it's very temporary. I think India is a very important merger market and investors want to participate. So this is not a secular thing, it's a temporary thing.
All right, I think we're almost out of time. I want to take a risk here, and without asking any of you your political, leanings, just from a market standpoint, whether or not you think, because I know there's a lot of buzz in the crowd about this, just whether or not you think we're in for a smooth transition. I'm trying to be as diplomatic as possible, but will we see a repeat government? Will we see a smooth transition? Are you expecting any surprises?
Well, really difficult to say, and the election results will be out on the 23rd of May. I think, as investors, we need to take a longer-term view of life, and if the results are good from the market's perspective, I think it's business as usual. If the results are not what the market expects it to be, we may see some near-term volatility, but in my opinion, that would be an opportunity to buy back into the markets.
Toss a coin, heads I win, tails you lose.
Elections don't matter. That's the clear message.
I think a lot of the work in terms of policy, which structural reforms we have done already, right? So it's just a continuation of that. I think should be good enough, irrespective of whatever governments come in, I think.
Okay. I think, Mahesh, we have, Bharat, I think we have one more question for you. Is it good enough for overseas equity investors to earn, say, 7% if 4 to 5% returns are shaved off due to our currency devaluation?
No, I don't think, 7% after the currency depreciation or before. Because if they're going to make 7 or if they're going to make 12% and currency depreciation takes a 4 or 5 and they're going to end up with 7, I think it's a very good rate of return. I think, they'd be very happy if they make 7 to 8%, after currency depreciation. That would be good enough.
Okay, and I think we have one more for Rhythm as well. I think we have time for that. When do you see India reaching 50% penetration in equity? What's required for it? And how do you see the government's financial inclusion initiatives helping?
50% penetration?
In equity.
No, we are very far away. I don't know what penetration word means, but I'll share some historical context. In 1991-92, in that financial year, the Sensex, it was my first experience of a bull market, and I have never seen a bull market like that after that. The Sensex went from 900 to 4,500, 5 times in 9 months, okay? In that year, investors, households in India put a quarter of their financial saving into equities. That is an equivalent of 3 lakh crores in a single year in current value terms. So, that's the type of potential we're dealing with. We are, as a nation, very attracted towards equities, which is why the Mumbai Stock Exchange has a near 150-year history. So some point in time, we will go back to those levels. I don't know when and how and where we will get there. 50% looks a little too far away, but who knows? We can, as I said, we'll be optimistic.
There's this proclivity to kind of see rationalist as pessimist, but when rationalist sees optimist, they think otherwise.
I'm interested to be a fly on the wall when this conversation continues later. But Mahesh, closing comments then from you.
I would say that, I mean, as we discussed earlier, I think India, while the global growth is slowing down, we don't have the tailwind. I think the foundation is there for India. For somebody looking to invest in equity with a longer term view, I think more important is not the absolute return, right? It's the longevity of that, right? If you're able to generate a return of even around 11, 12%, but over a decade or so, I think that's what creates wealth. And I think India has that foundation and potential to do that over the longer term. And that's why you should be in this market, stay invested, irrespective of the elections, whatever happens, whether interest rate go up or down. I think that's the one clear message I think I would like to say. And without really focusing on the near-term volatility, what's going to happen on the global front, I think investors need to look beyond that and make the right allocation. We are not making a case here that equities look very exciting, very high returns, moderate return, right allocation, both debt and equity. I think if we do that, I think investors should be happy.
Awesome. A big round of applause for this.
Rationality, be very rational with your money, okay? Optimist with your ideas.
Okay, a big round of applause, please. We've got a fabulous panel here today. Thank you so much, gentlemen. Thank you.